A lot of people are complaining about how you need 3 times the income to qualify for a rental. But what's amazing and often surprising to people is that in order to qualify for a mortgage, you really only need about twice the mortgage payment in income. So the guidelines are actually a little bit more lenient if you're applying for a mortgage versus applying for a rental. And you can actually have a little bit more purchasing power.
Hi, everybody. This is Jose Luis Morales. Welcome back. Today we have Stefanie Boyd. She works for a professional mortgage associate. She's been a loan officer for 20 plus years. Today, Stefanie is going to be guiding us as to whether it makes more sense to buy or rent. And she's also going to be giving us different examples of if you pay a certain amount of rent and if you buy a property with a certain amount, if you pay a certain amount of money as a down payment, what would those scenarios look like? So welcome to the show, Stefanie. How are you?
Hi, Luis. Thanks for having me. I'm great. How are you doing today?
Doing awesome. So I'm excited about this just because a lot of times when I used to factor in whether it made more sense to rent or buy, I never really factored in home appreciation. I never factored in principal pay down in that calculation. I never factored in interest deduction for tax benefits. So there was just a lot of things that I didn't factor in. And I'm imagining that there's a lot of things that home buyers and home renters are not factoring into that conversation. So I wanted to bring you on the show and kind of explain that to us. But before we get into that, just a little brief introduction. Who is Stefanie Boyd and how did you get involved in this wonderful world of mortgages?
My very first job as a grown-up was as a criminal investigator working for Sacramento County, and I did that for about 5 years before I joined my family's real estate brokerage in 2000. So we always strive to make renters into homeowners, and so our family motto was kind of working with those hard luck cases and just helping renters become homeowners. So that is how I got my start, and I've just carried that philosophy on as I built my own business. So about a year and a half ago, I passed the broker's test and opened my own company. So now I am working for myself and helping homeowners, helping renters become homeowners, helping homeowners build equity, and helping investors build their portfolio.
So for our renter clients out there, what are some of the things that they should be considering when deciding whether continue being renters or whether they're deciding to maybe becoming homeowners?
One of the biggest things I see people complaining about in my Facebook groups, for example, I'll just start here in my community groups that I keep an eye on. A lot of people are complaining about how you need 3 times the income to qualify for a rental. Well, I don't know where a lot of your listeners are, but I'm in California where our rents are high. If we're talking about a $3,000 a month rent, the landlord now wants to see $9,000 a month worth of income. So a lot of my neighbors and people in my community are, making more like 5 or 6 or 7,000 a month, and they're wondering how they're going to qualify for this basic rent on a 3-bedroom, 2-bath house. What's amazing and often surprising to people is that in order to qualify for a mortgage, you really only need about twice the mortgage payment in income. So rather than 3 times, you only need your debt to income ratio can actually be up to 56% with an FHA loan. And I just got a conventional loan approval with a 50% debt ratio. So the guidelines are actually a little bit more lenient if you're applying for a mortgage versus applying for a rental. And you can actually have a little bit more purchasing power.
Oh my God.
In addition to the fact that instead of sending your landlord's kids to college, you are investing in your own future and building your own wealth and your own family's intergenerational wealth and equity in your own home. So that's definitely a bonus among many, many others.
So what we're going to do, guys, is we're going to go over the different scenarios that Stephanie and I were talking about. And we're going to go over the different scenarios as to rent to own. So I'm going to share my screen with you guys. And then we're going to go over the first scenario right now, which the scenario is a purchase price of $600,000. It's assuming $3,200 in rent. It's assuming a 3% increase in rent. And then it's also assuming a 3% appreciation. So let me show you what we came up with. So what a lot of people don't realize is that if you just assume a simple 3% appreciation, that means that in a period of 180 months, which is 15 years, your home would have appreciated $334,000, which amounts to $1,859 a year. What I would say is I talked to a tenant yesterday that the seller is unfortunately selling the property, and they've been renting that property for 11 years. Even a 3% appreciation, which is very reasonable, that person would have built up, if you do it by monthly, approximately $1,859 a month. A lot of people don't realize that there's some tax savings. The interest rate whenever you purchase a property, and obviously talk to your accountant about this and verify this with your accountant, but the interest rate is actually deductible up to, I believe, $1 million. So as long as the purchase price or 900,000 or $1,000,001, somewhere in that range, don't quote me on it, but as long as you purchase a property for less than that, you can write off the interest. So if you're able to write off the interest that you pay on your primary residence, and you just assume a very low tax bracket of 15%, there's approximate savings of $329 per month. A lot of people don't factor in the appreciation. A lot of people don't factor in the interest rate or the interest rate savings on your tax basis. And what a lot of people don't also factor in is the principal pay down, that every single month your principal is being paid down as well too. Obviously, we ran different scenarios as well too. This is just a different scenario. This is one with a 60-month process. Like, let's say that you were not planning on holding on to the property for that long. In a 60-month, in a 5-year process, if you just assume 3% appreciation, you're looking at about $95,000 in potential equity built up on a property of $600,000, a savings of about $366 per month in terms of potential taxes. Now, we ran a wild scenario because Stephanie and I were talking about this off camera. We said, well, look, last year, properties didn't appreciate 3%. Last year, rents didn't appreciate 3%. Rents increased more like 10% in certain areas. And obviously, it varies area by area. But in some areas, housing appreciated 18%, 15%, 10%. It wasn't 3% that it appreciated.
It was atypical for sure.
Yeah, for sure. So it doesn't happen all the time. But look, if that were to happen where it was 18% every single year, you would build up about $6.5 million in equity. Now, we're not saying that's going to happen. And obviously, we're not saying that that's normal. But this is the stuff that people don't factor in. They just compare, like, this is how much my mortgage would be. This is how much I pay in rent. And then they don't factor in the potential appreciation, the principal pay down, or the interest rate write-off as well, too, that it does help you in terms of taxes.
So yeah, that's that long-term benefit versus the short-term gain. You don't see it till you kind of take a step back and look with a bird's eye view like we did.
So what I would tell to people is, in the short term, it may seem like I'm paying a lot of money out of pocket for the down payment, which Stephanie's going to tell us about a great program that she has to be able to help you with that. And it may seem like, wow, I'm paying a lot more than what I would be paying if I was paying rent. But when you actually think about it from a long-term perspective, 5, 10, 15 years down the line, and you factor in principal pay down, interest benefits, and you factor in also appreciation, then there's a huge benefit. Now, Stephanie, you actually have a solution for the viewers. Your solution is that there's a down payment assistance program, right? Or a down payment loan that people can use so that they don't have to come up with all this money out of pocket. Can you let our viewers know that are considering buying but are currently renters? Can you let them know what this benefit is?
Yes. In fact, there are a bunch of different down payment assistance programs. So they all work a little bit differently, but the new one that I'm real excited about is called the Equity Builder Program. So this is a forgivable second mortgage. And this is in California only, unfortunately. This is a Cal HFA product. And if you take this loan, today the interest rate is 5 1/8. So it's very reasonable, comparable interest rate. They will give you 10% of your purchase price towards your down payment and your closing costs. And all you have to do is make 5 years worth of payments, and it's completely forgiven at the end of 5 years. And I do think it's kind of the industry's response to a lot of these first time buyers being priced out of the market recently over the past
Mhm.
few months. And so our wholesale lenders are trying to figure out ways to help first time buyers still be able to get in. So this type of program, they do have income restrictions. So, if you make $1 million a year, sorry, you don't qualify for this program. These are for moderate income people. There are some that are more to low to moderate income. So, depending on what part, if you live in a more rural area, there are different down payment assistance programs available that have even lower income limits. But right now, if your income is, you have to have enough to qualify. So let's say 60 to the upward limit in some of these programs can be up to 124,000. So, there's a flexible range in there. In this particular equity builder program in my area of Sacramento, the income limit is about 81,000 a year. So that would put you right in that sweet spot of qualifying for, a 400, 450 house, and you get $40,000 towards your down payment and closing costs.
Does that mean that if they put the 10% down, do I still have to come, assuming I qualify and I make enough money for the loan, do I still have to bring money out of pocket to make this happen? Or does that mean that I could literally purchase it with 0% down?
Zero down. What you're going to
Wow.
do as the buyer is you're going to write a check for the earnest money deposit along with your offer,
Mm,
and
mm.
then you're going to get that back at the close of escrow.
That is
So
amazing.
it's 10% to go towards your down payment and your closing costs. So your closing costs are going to consist of your loan origination fee and all your title and escrow fees, lender charges, underwriting fees, as well as your prepaid taxes and interest and insurance and things like that. Whatever portion of that 10% that is not used towards closing cost will go towards your down payment. So this actually works with a FHA or a conventional loan. So typically your minimum FHA down payment would be 3.5%, but here we've got 10% to play with. And your closing
Wow.
costs are going to be maybe, 3%, let's say on this scenario. So with 3.5 down and 3% closing, you've got another 3.5% left over to put towards your down payment. So in this scenario, you would actually put 7% down, and then you would have 3% towards your closing costs.
And then because of the market slowdown, like I'm noticing that sellers are more open to giving closing cost credit. So there's a chance that, like, if let's say that you negotiate a credit with the buyer so that or the seller so that they pay for your closing costs, that means you can use the entire 10% as the down payment, basically, right?
I believe so. The lender may
Yeah.
have an overlay or a rule, but theoretically, yes, as long as there's no rule preventing that.
So a lot of people, like, one of the things that like if you're going to go off and rent and the owner's going to ask you for twice first month's rent and last month's rent and sometimes even an extra, you're looking at $10,000-$15,000 sometimes, depending on the amount of rent that you're paying. With a program like this, there's a good chance that you may be able to come with no money or very little money down. And then once you factor in the incentives that you receive in terms of taxes, appreciation, and interest pay down, there's a good chance that it made more sense. Here's what I would recommend to you guys. What I would recommend to you guys is for you guys to reach out to Stefanie Boyd and ask her to run a scenario for you. Tell her, look, Stefanie, this is how long I'm planning on staying at my property. I'm planning on staying at my property for 5-10 years. This is how much I currently pay in rent. This is how much I think houses would appreciate. And this is what income bracket or tax rate I'm at. And have her run an analysis for you, because if you have her run an analysis for you, she'll be able to give you a comparison and really determine whether it makes more sense for you to continue renting, or it might make a little bit more sense for you to get into the housing market. Not only that, but she may be able to connect you with some down payment assistance programs. So, Stefanie, anything else that you think we should add for our viewers?
I just want to reiterate, I think it's always better to build your own wealth than build your landlord's rent. Build your landlord's wealth by paying them rent. So, just add up all those years of rent, 11 years worth of rent. And at the end of 11 years, you still own nothing.
Nothing. Not only that, but the prices appreciated over that time. Rents went up over that time. So now she's coming back into the rental market, and rents are a lot more expensive now. So I feel bad for that family, but I almost wish that they would have took the leap 11 years ago, which would have been a good thing for them, you know?
Yeah, definitely. Because over 15 years, this person we're talking about is going to pay $714,000 in rent. So
Yeah.
I'd say you
Yeah.
might as well
It's
put that
crazy.
into your own pocket in your own bank account.
And a lot of times people don't do this because they're not aware of programs. So I hear so many misconceptions. People are like, well, I don't have enough money for the down payment. There's down payment assistance programs. Sometimes I hear people say, well, my credit is bad. You can fix your credit. There's credit repair companies that can actually fix your credit. So it's just a matter of getting a consultation by somebody that knows what they're doing, and that'll help you guys out tremendously. So Stefanie, if somebody wanted to get a hold of you, what is the best way for them to do that?
I am always available by phone, and my cell phone is 916-215-9811. And you can also find me on the internet at stefanieboyd.com. Stefani, just like Gwen Stefani, stefanieboyd.com.
For all of our viewers, thank you so much. On this episode, we had Stefanie Boyd. She is a mortgage broker / loan officer, and she went over with us the scenario, whether it makes more sense to buy or whether it makes more sense to continue renting. I hope that this episode was helpful to you guys. And if you guys haven't subscribed yet, make sure to hit that subscribe button. If you feel that this interview would be helpful for somebody, make sure to hit that share button. Thank you guys so much. And thank you, Stefanie, for being on the show.